It seems so simple. If your cost of capital is higher than your return on that capital, then your business is destroying long-term economic value. Alas, in Asia, it's been only too easy across the region to find companies that do just that, that have no economic value add or EVA. But now, there's some reason for optimism, at least according to Amar Gill, Head of Asian Research for CLSA. Amar, thank you for joining us today. Let's start at the top. Tell me why you're so optimistic.
Well, to some extent, it's because countries are responding to the challenges. Over the last 3 years, return on capital has come down. And to be frank, 3 years ago, you had a return on invested capital in Asia ex-Japan of about 13%, cost of capital slightly below 10. So companies were creating positive EVA. But over the last 3 years, EVA in this region has collapsed. This return on capital has fallen from 13% to 10. But what's happened in the last 18 months is that you've had changes in government. They're all responding to a similar external environment, an external environment where the US recovery is shallow, where Europe is still basically in recession, and then where in China, which has been the trading partner pulling up exports from the rest of the region, China's growth is also slowing down. And the new leaderships that we are seeing in these countries have to respond to the fact that exports are no longer the driver of the economy. The driver of the economy has to be domestic driven.
Let's focus on China for a minute. You have this wonderful statistic of the top 20 state-owned enterprises in China spending $180 billion a year on capital expenditure, yet 12 of those 20 are actually destroying economic value. How do you get from that to positive returns?
SOE capex in China is obviously driven by Beijing and the policies of Beijing. So we are more positive on certain sectors like petrochemicals, oil and gas, and IPPs. A little bit more cautious on other sectors like telcos. And it's partly whether the government has a national agenda that might conflict with maximizing shareholder value.
Okay, let's move away from China for a second and talk about elsewhere in the region. I mean, you mentioned the change of governments across Asia. If you had to pick one other country, where would you put your money?
We look at the correlation between return on capital and price to book. And 3 markets come out cheapest on that. Indonesia, Taiwan, and Korea. Korea is always looking cheap. And of these 3 markets, the change in government is about to happen. The elections results were about a month ago. In Indonesia, where Jokowi comes into power in October. And we think that Jokowi has made some strategically quite shrewd decisions. Just the choice of his vice president, someone who has credentials with the business community. I think that shows that actually Jokowi is quite a shrewd operator. And if I had to choose one market with upside, Indonesia is one of the markets we're emphasizing here.
Now, we've been talking about the upside case here. This is Asia, the area where investors will often talk about the triumph of experience over hope, where we have sprawling family empires or sprawling government empires. We have Korean chaebol. We have Japanese companies that can't ditch the smallest unprofitable units. How sure are you that this time it will be different?
It's not going to be different across the board, but for SOEs, they're driven by policies of the leadership. And so I think we have leadership change where they are serious about getting the companies to be more efficient. Across the private sector, Indian tycoons, not just in India, but in Korea, etc., quite often like to have the cash in the listed company because then they have a bigger pool of cash that they can control with a minority stake. And that is going to take time to change, but it has changed in Taiwan.
So political reforms to perhaps drive investor returns. Well, I hope you're right. Amar Gill, thank you very much.
My pleasure. Thank you.